Nedbank actually says that it's well placed to deliver earnings growth for the year in excess of its medium to long-term targets. And seeing this third quarter update, obviously very indicative of what we could see going forward from Nedbank. Quite a significant turnaround. Are you impressed with the numbers?
Yes, definitely so. I think the big driver of the results remains their non-interest revenues. So that's your fees and commissions, which are being driven very hard by the group. They've realized that in the past, given the smaller retail footprint that they have, that they've lagged their peers in terms of fees and commissions. And they've now focused on that, and it seems to be bearing the fruits. And we're seeing very strong growth in the NIR, non-interest revenue.
Patrice, looking at the credit loss ratio, it's improved to 1.13% from 1.21%. At what level would you like to see the credit loss ratio? Are you happy with it being just above 1? Would you like to see it lower than the 1%?
Yeah, at above 1 is still very high. In the past, it's fallen to extremely low levels. We're talking sort of below 50 basis points, which is probably too low through the cycle, but I would say closer to 80 basis points would be a more reasonable number. So I think they've got quite a way to go in terms of their cost to income, because the high level in terms of bad debts, the high level of bad debts are being driven by quite high bad debts in retail still.
Yeah. From your experience, and we've seen a marginal improvement there, how long does it actually take for a credit loss ratio to move 20 basis points, for example? What is the best case scenario and the worst case scenario?
Well, you've seen, and they've indicated that in today's trading update. I think they're taking a very cautious view of things. What that means is that as your book as you get rid of the problem properties, you tend to be left with a residual amount of properties which are quite problematic. And what they've done is taken extra provisions against those properties, which means that instead of just releasing provisions as the bad debt improve, they're just waiting to make sure that they can get these problem properties off their books first before releasing those. So I think they're just being extra prudent, which is the right way to go, because interest rates are very low, and if interest rates were to increase tomorrow, obviously the environment would be a lot more tricky for them to operate in.
Within the retail division of the bank, and of course you alluded to it, we're still seeing a bit of trouble brewing there, but it seems that they have managed to turn things around. How much improvement are you foreseeing as an analyst and investor? We know that the bank has said that they are relatively cautious, but I suppose they have to be, given the very uncertain environment going forward.
Well, this is going to be the big driver for growth going forward. We've seen already in the first round numbers, which delivered the highest earnings growth in the past year, that retail can be the driver, especially in the unsecured lending areas, because customer acquisition has been quite strong as well in the banking sector. So as soon as Nedbank gets around its home loans problem within retail, you'll find that earnings growth will be very strong in that division going forward.
Patrice, lastly, let's touch on the cost-to-income ratio, something that hasn't been delved into in today's trading statement. What kind of estimate do you foresee going forward? And it's actually been something that has been ticking up overall across the board for banks in South Africa.
Correct. Nedbank in the past has been one which has run at very low cost-to-income ratios. The cost-to-income ratios was around 50% at the beginning of 2000, and then it's ticked up as it's lost its advantage in the corporate and investment banking area, and has had to sort of build a bit more of a retail footprint. I think around the current levels of 56% is probably the right amount. The problem is that you can get a very low cost to income, but that usually is an indicator that the bank is not investing enough. And we're seeing right now the Nedbank in retail, just look at the adverts in terms of Nedbank Savvy and the like on TV. Nedbank has realized they need to reconnect with their sort of traditional middle market customer and try to regain that ground, because otherwise they'll have their lunch eaten by the likes of Capitec.